Former Texas school teacher Kayla Morris put every dollar she could save into a home for her growing family. When she and her husband sold the house last year, they stowed away the proceeds. $282,000.
Who stole away the proceeds?
Sorry, they stowed away the proceeds.
They
stowed away, yeah, proceeds. $282,153.87 in what they thought was of us as a safe place, an account at the savings startup Yotta, held at a real bank. Morris, like thousands of other customers, was snared in the collapse of a behind-the-scenes fintech firm called Synapse, and has been locked out of her account for 6 months as of November. She held out hope that her money was still secure. Then she learned how much Evolve Bank and Trust, the lender where her funds were supposed to be held.
Hold on. So you're saying that she sold the house, right?
Yes.
And how much she got from the house?
She $282,153.87.
So instead of putting the money in a regular bank, she decided to put the money in one of these new fintech startups.
The Yotta, right.
Okay.
Right.
Carry on.
So Morris, like thousands of other customers, was snared in a collapse behind the scenes fintech firm called Synapse, and has been locked out of her account for 6 months of November. She held out hope that her money was still secure. Then she learned how much Evolve Bank and Trust, the lender where her funds were supposed to be held, was prepared to return to her.
Listen to this.
We were informed last Monday that Evolve Bank and Trust was only going to pay us $500.
Out of $200 and something $1,000.
Out of that $280,000, Morris said during a court hearing last week, her voice wavering. It's just devastating. The crisis started in May when a dispute between Synapse and Evolve Bank and Trust over customer balances boiled over, and the fintech middleman turned off access to a key system used to process transactions. Synapse helped fintech startups like Yotta and Juno, which are not banks, offer checking accounts and debit cards by hooking them up with small lenders like Evolve Bank and Trust.
Remember Found? The Found? That's the same kind of thing. Fintech. They're not traditional.
And I tell you my reaction when you told me about Found.
She was like saying we don't... But I mean, they didn't get any money from us anyway. Anyway, continue the story. In
the immediate aftermath of Synapse's bankruptcy, which happened after an exodus of its fintech clients, a court-appointed trustee found that up to $96 million of customer funds was missing. Just missing. The mystery of where those funds are hasn't been solved, despite 6 months of court-mediated efforts between the 4 banks involved. That's mostly because the estate of Andreessen Horowitz-backed Synapse doesn't have the money to hire an outside firm to perform a full reconciliation of its ledgers, according to Jelena McWilliams, the bankruptcy trustee. Same one I was telling you. But what is now clear is that regular Americans like Morris are bearing the brunt of that shortfall and will receive little or nothing from savings accounts that they believe were backed by the full faith and credit of the U.S. government. The losses demonstrate the risks of a system where customers didn't have direct relationships with banks, instead relying on startups to keep track of their funds, who offloaded that responsibility onto middlemen like Synapse. Reverse bank robbery. There are thousands of others like Morris. While there's not yet a full tally of those left shortchanged at Yotta alone, 13,725 customers say they're being offered a combined $11.8 million despite putting $64.9 million in deposits. According to figures shared by Yotta co-founder and CEO Adam Moelis, CNBC spoke to a dozen customers caught in this predicament. People who are owed sums ranging from $7,000 to well over $200,000. From FedEx drivers to small business owners, teachers to dentists. They describe the loss of years of savings after turning to fintechs like Yotta for the high interest rates and on offer. High interest rates on offer for innovative features or because they were turned away from traditional banks. One Yotta customer, Zach Jacobs, logged on to Evolve's website on November 4 to find he was getting back just $128.68 of the $94,468. 92 he had just deposited.
So wait a minute. He deposited $94,000 and they gave him back only
$128.
Oh my God.
And he decided to act. The 37-year-old Tampa, Florida business owner began organizing with other victims online, creating a board of volunteers for a group called Fight for Our Funds. It is hoped that they gain attention from press and politicians.
Good luck with that.
So far, 3,454 people have signed on, saying they lost a combined 30 million, whatever. When you tell people about this, it's like, there's no way this can happen. A bank just robbed us. This is the first reverse bank robbery in the history of America. Andrew Malone, a chemical engineer from Chicago, said he had hoped to see the return of $200,000 he deposited with Yotta. Early this month, he received an unexpected PayPal remittance from Evolve Bank and Trust for $5. When I signed up, they gave me an Evolve routing and account number, Malone said. Now they're saying they only have $5 of my money and the rest of it someplace else. I feel conned. Cracks in the system, unlike meme stocks or crypto bets, in which the user naturally assumes some risks. Most customers viewed funds held in FDIC, Federal Deposit Insurance Corporation, backed accounts as the safest place to keep their money. People relied on accounts powered by Synapse for everyday expenses like groceries and paying rent or saving for events and so on, or surgeries. Several people CNBC interviewed said signing up seemed like a good bet since Yotta and other fintechs advertised that deposits were FDIC insured through Evolve Bank and Trust. We were assured that this was just a savings account, Morris said. Here, we are not risk takers, we are not gamblers. A Synapse contract that customers received after signing up for checking accounts stated, the contract that they received signing up for checking accounts stated that user money was insured by FDIC for up to $250,000, according to a version seen by CNBC. According to the FDIC, no depositor has ever lost a penny of FDIC-insured funds. Right, that's what the contract states. We are responsible, abandoned by U.S. regulators who have so far declined to act. Really. They are left with few clear options to recoup their money. In June, the FDIC made it clear that its insurance fund doesn't cover failure of non-banks like Synapse, and that in the event of such a firm's failure, recovering funds through the courts wasn't guaranteed. The next month, the Federal Reserve said that as Evolve's primary federal regulator, it would monitor the bank's progress in returning all customers' funds. We are responsible for working to ensure the bank operates in a safe and sound manner and complies with applicable laws, including laws protecting consumers, said General Counsel Mark E. van der Weed in a letter. In September, the FDIC proposed a new rule that would force banks to keep detailed records for customers of fintech apps, improving the chances that they qualify for coverage in a future calamity and cutting the risk that funds will go missing. McWilliams herself, a former FDIC chair during the first Trump presidency, told the California judge handling the Synapse bankruptcy case last week she was disheartened that every financial regulator decided not to help. Really? The FDIC and Fed declined to comment for the story, whatever. McWilliams didn't respond. Things hadn't always seemed so dire. Early in the proceedings, McWilliams suggested to Judge Barras that customers be given a partial payment, essentially spreading the pain for everyone. But that would have required more coordination between Evolve Bank and Trust and the other lenders that held customers' funds than what ultimately happened. As the hearings dragged on, the three other institutions, AMG, National Trust, Lineage Bank, and American Bank, began disbursing funds they had, while Evolve Bank and Trust took months to perform what it initially said would be a comprehensive reconciliation. Around the time Evolve completed its efforts in October, it said it could only figure out the users' funds it held, not the location of the missing funds.
So the people did not get their money back?
That's at least partly because of a very large bulk of transfers of funds without identification of who owned the money or a lawyer for Evolve. Without identification of who owned the money. A lawyer for Evolve Bank and Trust testified last week. As a result, the bankruptcy process has minted relative winners and losers. Some users recently received all their funds back, while others, like Indiana FedEx driver Natasha Kraft, received none. She told CNBC. Evolve said that the vast majority of funds held for Yotta and other customers were moved to other banks in October and November of 2023 on directions from Synapse, according to Evolve spokesman. Where those end users' funds went after that is an important question.
Nobody knows where the funds went.
But unfortunately, not one Evolve can answer with the data it currently has. Yotta says that Evolve has given fintech firms and the trustee no information about how it determined payouts, despite acknowledging in court that a shortfall existed at Evolve prior to October 2023, according to the spokesman for the startup, who noted that several executives have recently left the bank. We hope regulators take notice and act. In statements released ahead of this month's hearing, Evolve said that other banks refused to participate in its efforts to create a master ledger, while AMG and Lineage said that Evolve's implication that they had missing funds was irresponsible and disingenuous. As the banks and other parties hurl accusations at each other and lawsuits pile up, including pending class action efforts, the window for cooperation is rapidly closing, Barras said last week. As time goes by, my impression is that unless the banks that are involved can sort this out voluntarily, it may not get sorted out, Barras said. There's nothing optimistic about what I'm telling you. And there you have it.
So these fintech firms, non-traditional banks, don't stop it. I'm gonna edit stuff.
Mm-hmm.
These non-traditional banks, they are getting people to sign up, deposit their money, and the people are under the impression that it's FDIC insured.
Right.
However, if you read the fine print, FDIC only insures traditional banks.
Right.
So they're just finding out that now. So it's a FAFO type situation.
Right. Because the Evolve Bank and Trust, they're sort of used as a cover for the fintech.
That's right. Yes, exactly. Because they have to work through a traditional bank.
Right.
What a mess. What
a mess indeed.
Anyway, so what's the weather gonna be like this week?
Well, we're getting some sort of more winter weather or wintry weather. Some more rain and,
More rain gonna come?
And possibly snow, I think, coming up.
For Thanksgiving, what kind of?
Thanksgiving, yeah, right, because Tuesday will be some rainy weather, wet, rainy, snowy at places. So we'll get some more Tuesday. So.
Alright, so let me stop it now then. So it's like all this little stuff you can